Good morning and welcome into Your Financial Independence, where we're always trying to grow your financial independence. I had to make a video on this. So is this a good maybe potential value play, being that Netflix has dropped down? I mean, we were looking at highs of around $550 a share on April 20th. And then it randomly shot all the way down. I mean, some of this was probably below $500 that you could get shares of Netflix for. So today we're going to dive deep down into Netflix to see, is this a potential buy, being that the recent stock has fallen. On the CNN business, Netflix stock fell around 5% after hours trading Tuesday after the company posted slower growth in new subscriptions and lower than expected profits, a sign that the streaming giant pandemic bump may be petering out. So I do want to add that this company has a lot of growth still left in it, in my personal opinion. I'm not a financial advisor. In my opinion, though, I don't feel like a FANG stock is going to be going anywhere. There's a reason why this company became a FANG stock. And companies, they tend to figure stuff out. And if you wait until the end of this video, I have a pie chart that I want to show y'all that I think they still have a lot of revenue they can bring in. So the company said it added 2.2 million net memberships in 3 months ending in September 30th, down from 6.8 million new memberships during the same period of last year. This addition brings Netflix total subscription to nearly 195 million, lower than 196 million that Wall Street analysts were expecting. And there's a lot of expectations with any kind of stock like this that benefited from the pandemic itself. So Netflix has thrived through 2020 as people were stuck at home during the global health crisis. But there have been questions about whether it can continue that momentum, especially as competition and other streaming providers ramp up. So Netflix is forecasting an additional 6 million new paid memberships during the final 3 months of this year, but that would bring a total new memberships for the year to 34 million. So that's still well above the prior annual high of 28.6 million. It also expects paid new ads to be down year over year in the first half of 2021, given the massive spike earlier this year. So these companies are going to scale them back down away from ads. So you can expect that in the next quarterly report. So I did want to point out, this is something that may be worrying investors in the stock, especially investors that have been in this company for a very long time and are starting to take profit now. So Netflix, you see here, has subscriptions, and this is all in millions, of about 204 million. Amazon Prime is right behind them with 150. Disney Plus 87, Hulu 39, HBO Max 38 million, and the list goes on from there, with Apple TV Plus coming in anywhere between 10 to 33 million. But they're going to have to figure out, how do we get the people who are sharing our service to actually start paying us revenue? I'm sure most of y'all are like, no,
I've got multiple accounts that I'm sharing with my family.
Yes, but if you're an investor in this stock, then you're going to want them to figure out, how do they get that revenue from these people that are sharing accounts, whether that's family members or different households, or even sharing with relatives. So it's coming in below 50%. It's at 47.5 is the people who don't share, that pay for the account that they watch. And with this, your financial independence viewers, I hope this gave a good overview and maybe explain, should I still buy the stock on the dip? Should I stay with the company if I'm already invested in them? As I pointed out, some of the potential revenue gains that this company could have in the future, as long as they kind of figure out a way to actually get that revenue growth from the people who share this product with multiple different accounts. And I hope this brought some insight of maybe why the sell-off is occurring. And with that, I hope you have a great day.